everybody, and really pleased to have the opportunity here to present a number of our speakers who include Khalib Abedin, who's the Supervisory Investment Officer at the DOE Loan Programs Office, and earlier in his career he was with the private sector in energy and risk management. Khalib is working in the Loan Programs Office and actively reviewing various projects that have interest in taking advantage of the opportunities there for carbon capture related projects. Also with us is Chris McLean. He's the Assistant Administrator with the Rural Utility Service Electric Programs, and is also looking at opportunities for the RUS to provide debt to support carbon capture projects. Both Khalib and Chris will be making presentations about their office's programs and offerings. Jeff Brown also joins us. He is a professor of clean energy finance at both Stanford and the University of Wyoming, and is the head of their University of Wyoming's Enhanced Oil Recovery Institute, and also advises on clean energy and carbon capture for companies and also not-for-profits, and has been studying from an economic perspective the different sources of capital that are going to be required in connection with build-outs of carbon capture facilities in the U.S. Finally, I'm joined by my partner, Sharif Barakat. He is the tax equity voice for this call. As most people know, debt and tax equity are going to have to work together in order to provide the financing sources that are necessary, and we really appreciate having Sharif participate, and also will be a moderator of the questions at the end of the call. We are going to go through a bunch of presentations, and during which you should put your questions in the chat box or the Q&A box, and then at the end, the last 15 minutes or so, we'll try to get through as many of those questions as possible. So, as many of you know, there are not too many actual financed carbon capture projects, if any. So we are sort of looking forward and trying to project what we see or what we anticipate will be possible in the future, given the laws in place, the metrics that project finance lenders would typically look to. And so we're going to be proposing some interesting structures, probably some new to some of you, and also basically talk about the pluses and minuses of using debt in the structures as a primary matter. We also would like to just caution you that the RUS and the DOE are very large institutions, and our speakers representing those institutions are not speaking for their institutions, but are speaking for their institutions. But please do not require or ask them to address project-specific questions, which I think they would rather speak in more general terms. So with that, I turn it over to Khalib, who's going to kick off the presentation from the DOE side.
Thank you, Alan. Good afternoon, and thank you for joining. I'm going to give you a highlight about our program and going to cover a little bit of detail about the fossil energy program, where the CCUS technology being covered under the fossil program. Before I start, just want to let you know that Loan Program Office is a lending entity within Department of Energy. We are just like a bank, but we do have some different characteristics that how do we differentiate from a commercial bank. We provide debt capital to those projects where private lenders are not comfortable taking a technology risk. This is because there are significant concern on the technology. So we come in and we fill that gap. We are not competing with the private lenders. So this is a very unique role that we play to commercialize those technology. We work with potential applicants, sponsor, and investors, and have early engagement where no other lenders are willing to do. We also provide flexible financing, customized, that meets the borrower's needs. Because of our lending capacity, we can back up different structure and also underwrite with a very large check. This brings certainty and credibility and liquidity in the market. As an anchor lender, we can partner with private lenders once it is well structured and bankable. But for some reason, if there are no private lenders available, we can fund the entire project by ourselves. We are a committed partners offering expertise to borrowers for the lifetime of the project. We are held to maturity investors. We do not transfer the risk or sell the loan to a third party. We are taking the technology risk, construction risk, and operation risk of the project. We do have experience, portfolio management group that have decades of experience in managing and monitoring those risks. Although it is the responsibility of the borrower to execute different aspects of the project, but we become a committed partners in this process. We are proactive on our oversight role, but also when things go wrong during construction and operation phase, we bring all parties together to resolve the issues very quickly. We are a one-stop shop. There are no other lenders who can provide in-house consultations covering technology, environmental issues. We also have in-house legal lawyers, as well as transaction lawyers, as well as people experienced in lending activities. Moving along, I just want to give you a very quick overview of our portfolio right now. As you can see, we have a very diverse portfolio that covers nuclear, wind, solar, geothermal, and also advanced vehicle manufacturing. So that is the portfolio that we have right now. We do have a $2 billion conditional commitment outstanding in fossil energy with the CCS project. It is to Lake Charles Methanol. So it is a petcoke to methanol project where the CO2 will be captured and sequestered. Our total availability among all programs is about $40 billion, but for today's purposes, we are focusing on $8.5 billion that we have available under Title 17 that covers the fossil energy. Just for your information, we do have other programs which are renewable, nuclear, tribal energy guarantee, as well as advanced technology vehicle manufacturing. So in terms of fossil energy, I want to highlight what are the eligibility requirements. There are 4 criteria that which are required to be eligible for our program. The first one is that the technology has to be innovative. In other words, it has not been deployed and it is not in commercial use. We consider anything above 3 or 4 technology project would be considered as a commercial. So we like to consider innovative means that it has not been deployed for the first 3 projects. The second is that the project has to reduce, avoid, and sequester greenhouse gas or air pollutants. And it has to be located within the U.S. and its territory. And lastly, it is a loan, it's not a grant, so the project has to have a business propositions, a reasonable prospective repayment of loan. In terms of the technology, some of the areas which include like advanced resource development, carbon capture, efficiency improvement, and low carbon power system. These are some of the technologies in the fossil area that we look at, but we can be open for any other type of technology within the fossil sector. In terms of the CCUS technology considerations, the CCUS project fits within the technology eligibility criteria because we also look into, in addition to technology improvement, we also look into reduction of anthropogenic emissions and greenhouse gas. Our solicitation specifically calls for projects that integrate fossil fuel usage in traditional process with new and improved technology that capture and remove the CO2 for permanent storage or any other beneficial reuse. It could be EOR or other usage. Loan Program Office can also support infrastructure, products, and services necessary to catalyze CCUS technologies that are in an early stage of commercial deployment. For example, we could also expand a pipeline infrastructure to transport capture CO2 that can be utilized or stored. So a pipeline project, would qualify, for our program. Moving along, in terms of the business considerations, as I have highlighted, that we operate similar to a commercial lenders. We are willing to take technology risk. That is the reason that we are funding this project, because the private lenders are not willing to take that risk. We also look for strong cash flow to support O&M and debt service. We can talk about that later. And also, we are willing to collaborate with borrowers to reach a bankable structure, such as we get into early consultations and also get into discussions about how to make the deal in a structure that is bankable. As an anchor lender, we are actively engaged throughout the project life. We keep the loan in our book until maturity, and we're willing to work with all the stakeholders, during the life of the loan. With that, I'm going to pause here, and I'm looking forward to answer any questions. Thank you.
I was on mute. Sorry, next is Chris, and he's going to talk about the RUS offerings for CCUS projects. And we need to advance this to the next slide. Not sure who has control. Oh, I guess I do. Okay, Chris, here you go.
Okay, great. Well, thank you very much, and good afternoon. I'm Christopher McLean. I'm the Assistant Administrator of the Rural Utility Service Electric Programs. We're the successor agency to the Rural Electrification Administration. So next slide. Our origins, the Rural Electrification Act in 1936. This is our purpose, is to finance for the purposes of improving and furnishing and improving electric and telephone service in rural areas, and for the purpose of assisting our borrowers implement demand-side management, energy efficiency, energy conservation, on-grid and off-grid renewable energy systems. Next slide. So basically, the RUS, Rural Utility Service, again, as the successor agency of the Rural Electrification Administration and the administrator of the Rural Electrification Act, any part of the electric infrastructure ecosystem that serves eligible rural communities, which in general, with lots and lots of footnotes, I should advise, in general, as communities of 20,000 or less, we can finance. So we finance distribution, transportation, transmission, generation, smart grid, energy efficiency, cyber security, grid security, renewables, storage, and we have looked at carbon capture, utilization, sequestration, and we do have some authority to be able to do that. We are focused on hard assets, and all of our projects that we finance must be first eligible under the Rural Electrification Act, as well as any relevant appropriations requirements, must be financially feasible, and must be fully secured, providing the U.S. government reasonably adequate security to ensure that the loan gets repaid. So next slide, please. We are an incentive lender, so there's a little bit of contrast to what the Department of Energy does. We do not require a credit elsewhere test. We do not require you to be unfunded by others. We're looking for really solid borrowers. The whole concept behind our program is to use the low interest rates that we can provide and the access to affordable capital in order to incent private parties to be able to, or public entities, to do things that they would not otherwise do. In other words, serve hard to serve rural areas. So we are not a lender of last resort. We are a lender that's trying to incent behavior. We focus on infrastructure lending. There are a few minor exceptions to that rule, but think of us as financing hard assets, infrastructure, and again, with very, very small exceptions, we do not finance operations. There's two basic kind of loans that we'll look at. A system loan, where we finance the entire electric utility. We have borrowers that have been with us since the 1930s, 40s, and 50s, and we have a lien on all of their assets. We finance their system on an ongoing basis. And then we also have project loans, which have emerged in the last decade or so, where we will work with project developers and particularly, let's say, in a renewable project, a solar developer will be working with us, and we'll provide up to 75% financing on a project loan. We insist on a first lien on all assets, or a shared first lien, or in the case of municipal or tribal utilities, we would want something comparable. We usually have a pledge of revenues to be able to secure the RUS loan. So even for tax equity financiers, the U.S. government under the RUS program expects to be in a first position in terms of a lien on the assets of the project. And while cooperatives, rural electric cooperatives, are our most noted customer, RUS is fully able to make loans to investor-owned utilities, municipal utilities, and tribal utilities, and we do to all of them. So next slide. Now, why would people want to do business with us? Well, we're having a money sale. I mean, there's no better time to be able to finance infrastructure than right now. These were yesterday's rates. So these are the we use the Federal Financing Bank, and we have the rates expressed here plus 0.125%. So for 30 years, you're well under 2%. It's an incredible amount of financing. And these rates get set on a daily basis, and you start paying interest on your loans, not when you receive your approval, but when you draw the funds and use the funds. And in a project finance, we will typically be the takeout financer. So there will be an interim financer during construction, and we will then take out that interim financer upon delivery and operation. Next slide, please. All right, here's the big kahuna for today's presentation. This is this year's appropriations language, and we only have 2 weeks left on this fiscal year. So we have no reason to believe that Congress is going to change this, but this has been roughly the formulation of our appropriations, we can do about $5.5 billion of infrastructure financing, but it says in the current appropriations that up to $2 billion could be used for construction, acquisition, design, engineering, or improvement of fossil-fueled energy-generating plants, whether new or existing, that utilize carbon subsurface utilization and storage systems. So that's a very critical point as to what Congress has said that we can finance. So one, it has to be related to electric generation, and two, it has to be a subsurface sequestration. So next, please. Just as an example of our interest in this topic, here is a list of our existing RUS borrowers who do have coal assets, and all of them are looking at the future, and so we do have we do follow very closely the good work that the Department of Energy has been doing in carbon capture sequestration. We have looked even a number of years ago at other projects that have involved carbon capture sequestration, and we expect that the interest that we've been experiencing in the last several months may mature into actual loan applications to do so in RUS. Next slide. So what's really important to understand about RUS, it goes back to those statutory provisions I shared. The core of our mission is rural electrification. So we have to have an electric purpose, and we can do carbon capture related to the generation of electricity, and we can do carbon sequestration as long as it's, again, per that appropriations language, subsurface. So there's going to be some carbon capture projects that we're just not going to be able to be a player on. So if it's for an industrial carbon capture at an ethanol plant, for example, well, that's not involved in the generation of electricity. And even though it might be a subsurface, I can't play because it's not related to the generation of electricity. Or it could be the carbon capture, but then carbon is utilized in an industrial or manufacturing purpose. Well, that's not subsurface utilization, so I'm limited by my appropriations language there. The other thing is, if I am asked to finance just the carbon sequestration portion of a project, but not the electric generation, I may have some issues. So it's very important to understand what we can finance vis-a-vis what Congress has given us authority to finance. And then we would, that opens the door on eligibility of what we can consider. We are, again, because we're not lenders of last resort, we are tough bankers, but we're tough bankers with a very good interest rate and a very strong mission to be able to serve rural areas. So I think, there is some opportunity for us to be a participant. We're also very much willing to be a co-lender with others, again, provided we have a shared first lien position. So it may be possible for us to have the green light to finance improvements on an electric generation facilities plant that would make it available for carbon capture sequestration, but maybe not, we might not want to finance the pipeline that takes it to an ultimate destination. So next slide. So eligibility is our front door. So we want to make sure that it serves the rural community, that it meets our appropriations language, and that it is gone through the environmental process, both for National Environmental Policy Act and Section 106, which is historic preservation, as well as endangered species and other environmental rules. They have to have compliance with those. Projects have to be financially feasible, so we don't like taking risks. We like the sure thing. And the technology, we don't take technology risk. We expect that it is a proven technology. So we have to be able to walk from experimental to proven. It can still be early proven, but it has to be proven and reasonably suitable. And then, of course, it does have to be fully secured. RUS has a negative subsidy rate, and that's a good thing in the federal budget. That's because our borrowers pay us back, because our loans are loans. We don't, they are full recourse loans, and we do expect to get repaid, and fortunately we do get paid. Next slide. So we're very optimistic about carbon capture, and as I showed you, and we do have a meaningful, large portfolio of coal investments, but we are a bank that invests prudently. The technological and financial risk must be minimized to be able to protect both rural consumers who will be paying for the technology, as well as U.S. taxpayers. We have an extraordinary staff. I'm very, very proud of my team, and my colleague Joe Baden and Ken Solano are two of the best engineers in the entire federal government. Both have deep experience in the electric industry as well as in the technologies related to carbon capture. So the technology has to be commercially available, the loans have to be feasible, and the loans must be secured. Next slide there. So is it eligible, is it feasible, and can it be secured? Those are the big three questions. And I've got a slide here coming up next, which gives you a little bit of a more detail. I'm not going to go into a lot of detail here, but this gives you a little bit of the flow chart of starting your engagement with RUS, leading to the approval of the loan. I want to point out in particular, one of the most important factors to consider, and the wild card in almost any government loan program or grant program, that's the environmental review. You are advised, particularly if you have multiple federal and state agencies engaged in your project, to get that environmental review underway, settled, and get the arrangements between federal agencies as to who might be lead, who might be cooperating, because the nightmare scenario is to have multiple federal agencies with multiple sequential environmental reviews. And that's going to really slow you down. If you're working with the 45Q tax credit, there's a limited lifespan for that tax credit. So speed and efficiency are very, very important. So I have to highlight environmental review. One of the quickest ways to deal yourself out of eligibility for RUS financing is to begin construction prior to the environmental review. Then we will not be able to be a player. So you want to get that lined up. We can permit construction prior to loan approval, but after the environmental approval, as long as the borrower is willing to take the risk that we don't actually get to the final loan. But if you start before you have environmental review complete, you're going to be dealt out and just be ineligible, and we're not going to be able to help.
Chris, I'm just going to interrupt you for 1 second here. The term beginning construction is a pretty loaded set of words, and for purposes of being able to satisfy the timing rules under the Section 45Q, lots of developers are thinking about how they can quote unquote satisfy the beginning construction rules, which means something I think different than what you're talking about, which is actually putting a shovel in the ground. Although that might be one way of, qualifying for beginning construction, but I just to be clear, you're not talking about that same concept, right?
Well, I am talking about coordinating that concept. The Department of Treasury's definitions may or may not work well with our environmental regulation. So it is critically important, if you're contemplating RUS financing and 45Q financing, that you coordinate that sufficient start of construction to ensure that what would qualify for the IRS would also qualify for RUS. So you're correct. There are some procedures where you can begin preparations for a project that won't deal you out, but you got to be real careful. And so that's why I just put a big yellow flashing light around this point, is that the earlier you get a handle on that environmental review, and particularly the coordination between the different agencies, and projects of this size are going to have a bunch of very good professional people with background in environment as well as law that can help thread that needle. And so it's possible to be able to work both, but I just want to be very, very careful and cautious, and also warn that just because one federal agency says something is okay, it may not pass muster with another federal agency. Because each one of us has our own NEPA statute, or I'm sorry, our own NEPA regulation, and there are slight things. For example, I would doubt, I mean, Department of Energy has a NEPA regulation, but I doubt that their NEPA regulation takes into consideration prime farmland, where the Department of Agriculture regulation does. So those are the kind of things that you have to watch out. We have certain requirements related to acreage. In other words, size of a footprint of a project that may trigger one level of review or not. You just have to be conscious of what our regulations are for environmental review if you're interested in getting RUS financing.
Okay, great. Do we have any other slides?
And then I think that's the end. So my contact information should be the next slide. And a big thank you for giving us a chance to present it. This again, I think there's just premature construction can block RUS funding. I think that's the message. So please be careful, and we will work with others. It would be kind of fun to stack up a project with Department of Energy and RUS and private financing, and we work closely together on lots of issues, and we look forward to working together on this one. So if anybody needs to contact me, the next slide has all my contact information.
Great.
So thank you.
Yeah, thank you. So just keeping going forward, given the time, we're going to flip to Jeff Brown now, who's going to show us some numbers and some real cases here, and try to figure out where the debt might fit into the structure.
Yeah, thanks, Ellen. And can you hear me?
Yep.
Okay. And folks, I think the flow here is the last two gentlemen were describing the availability of low-cost debt for eligible CCS projects if it's a good borrower. And so what I'm going to really talk about is how do you arrange cash flows so that you're actually a good borrower, and they're going to let you through the door. Or if you get through the door, they won't throw you back out the door. So next one, kindly. And I have to apologize. I do teach finance. So no, do I advance or do you guys?
Well, I've been doing it, so
Cool. Good.
For you.
Fire away. Next one, please.
The summary?
Yeah, perfect. Right.
Summary there.
So I want to talk about two things: why you need debt so badly in a project, and the tricks of getting it given the particular circumstances of CCS. So debt's the cornerstone of project finance. No debt means your cost of capital is too high and you won't be able to compete. You won't get selected to do your deal. Debt requires a predictable amount of annual net operating cash flow pledged to lenders, and that's net cash flow after you pay operating expenses. Well, there's two issues here, and I'll get to both of them. First of all, when you think about borrowing, you're borrowing against cash, but the federal tax incentives, which are the absolute bedrock to carbon capture, since we don't have carbon tax, the problem is those incentives are non-cash. You can't borrow against non-cash. Now, if you could turn your tax incentives into cash, then you could borrow against them and you would have a nice, cheap cost of capital. Second to last bullet point, the standalone power projects are especially tricky because in most cases, they actually have negative operating cash flows. The money in, say, from selling CO2 to an oil project is typically less or a lot less than the operating expenses. So everything may look good on paper, but the issue is you've got negative cash flow, not taking account of the tax credit. And a bit of a ray of light is sometimes if you have the generation and the carbon capture project, the two sets of assets stuck together in the same package of cash flows and collaterals, it may work out better, but that's unusual. Next slide, please. So this is very quickly. This slide sets the background as to why project finance is important. If debt finance, if you look at this, I've got just a simple little miniature natural gas power plant, 1 megawatt. And what I'm showing is in the left, if I'm able to use debt, my total fixed costs a year are $112,000 per 1 megawatt. If I can't get debt, all equity, it's $142,000 per 1 megawatt per year. Well, if you multiply that times the size of a power plant, it's more like 18 million a year difference between those two. You can't compete with an all equity capital structure. Next, please. Now, in the next couple of slides, the next 4, we're going to do the same thing every time. Up in the top left, you'll see cash revenue and operating expense and annual net operating cash flow, like that negative 4.5. That's actually not a very handy number. If that was a positive number, you can borrow against it. The money you can raise from debt plus the value of any money left over is what equity is worth. And you hope that the money you can raise from debt and the equity value of the rest of the cash flows will sum up to more than the project costs. If you can't, in this case, this costs $250. If you can't raise $250, you are not feasible and nothing will happen. So here we go. The cash revenue here from EOR, and everything here is normalized for a project where you can capture 1 metric ton of CO2 per year. So my cash revenue from selling for EOR, say, is $19 a ton, but my operating expenses are $23. So I'm actually in the hole $4.5 a ton. Well, so actually, if I own this project, now I've still got cash, I still have tax value, which I'll get to, but so far, if I take the net present value of those 4.5 per ton each year over 12 years, the life of 45Q, I'm in the hole $28. Now, but I will get the non-cash tax equity, and I'll present value that. I get $217, but then I remember that I had to pay the 28, so I've only got $189. Okay, that's how much this thing is worth to me from a cash flow point of view. But the cost of the asset was $250. I'm not feasible. I will not do this project. So next slide. Here's one way that has been suggested to fix this, and I'm trying to both use it to explain and motivate to the extent that anyone of you hear about this direct pay idea to show you why it is important. So here, we've got the same math through to the negative 4.5. But now, at least for the first 12 years, something good happened. I'm the owner. I earn $35 for the ton, but the U.S. government actually says they will give me cash. So all of a sudden, I've got 30.5 of free cash flow every year. Now, I can borrow against that, right? I have an income stream. Now I can borrow. Next, I'll say that the bank or DOE or RUS let me borrow. I can't just count on 30.5 every year. Something could go wrong. But they'll let me count on 2/3 of that as my mortgage payment, just for instance. So 20 a year. Okay, I can take 2/3 of the 3.5. I can borrow against it. That gives me $191. And I still have some leftover cash, 30.5 minus the 20, 10. I still got another 69. I add those up. The sum of the debt plus the value of the equity is 260. It's more than what the asset cost. I am feasible. I'm in good shape. Now, the trouble is this takes a statute change. So one more slide. Here's something kind of in between, and Ellen will talk about this. But here's a situation where even though the IRS will make the owners who are going to receive the tax credits put up half their money up front, they can put in half the money over time. So here what I've got is I split the $35 into two bits. One bit I'm going to pay for up front. The other bit I'm going to, as equity, I'm going to pay that as cash in to the flow of funds that the bank has control over every year. So that's where that 17.5 up top is. Now, again, I've got 13 of positive cash flow. I can borrow against it. I only get 49 because it's a little smaller and I have a safety margin. But the point is that debt, 49, plus the remaining cash flows, plus the half of the 45Q I paid for up front, I get to 206. I'm short of the 250, but I didn't miss by that much, and it could be a cash grant or maybe more security, so I don't have to have such a good coverage margin, et cetera, et cetera. There's a lot of little tweaks that could make this go into feasibility. The next slide, I'm going to show, I mentioned that sometimes if you are putting together the power plant and the carbon capture together, it may be easier to finance. So here I've done that, but I've also given myself a long-term power contract with the local utility approved by the PUC, sort of like you had for wind or solar, at $45 a megawatt hour for this mostly decarbonized power. Well, without belaboring the numbers below here, all of a sudden I've got really two streams of revenue. I've got the EOR, sales price, but, for selling the CO2, but I've also got a bunch of cash revenues for the power, relatively modest operating expenses. So I've got 70.9, a big number that I can borrow against. That produces a lot of debt. I've also got the value of the leftover equity cash flows, and I've got the 45Q credit. And also just note, because I've got a positive cash flow every year, the 70.9, I can run this project out to 20 years. So the payments all add up, the cash flows add up to more because I've got them earning a longer period of time. So this power purchase agreement with the local utility, not only did it give me a lot of extra money flowing through and solid guaranteed money, but it's for a long period of time. All that helped my feasibility. So I'm on to, I think, the last slide, or second to last. If anybody wants to look later, I did cases, these three cases for coal CCS only, gas CCS only, and this power purchase agreement case. And let's go to the last slide. So big picture, most cases, there is no economic value to the CCS project without 45Q. It's also quite likely that there are negative operating cash flows, which raises a tax question. If the IRS question can be solved, which Ellen will get to, and if the credits can be turned into cash, a lot of projects will work. You could turn the credits into cash either through a pay-go structure or if statute changed. And finally, states can do a lot to increase the chance of success for power projects with CCS via long-term PPAs. Thanks, Ellen.
Great. That was really great. Thank you, Jeff. So I guess one question is a follow-up. Are you seeing their PPAs being executed now with higher pricing? And maybe we're getting ahead of ourselves here, for quote unquote net zero or CCUS project, as opposed, to there just being renewable PPAs out there.
No, and the problem is that most states, though not all states, have said the only thing that they want to have with a fixed power contract are things that count as renewable energy. And even if you had a carbon capture project that emitted zero CO2, it's not treated as renewable. So CCS falls into the same bucket with nuclear or large hydro and even biomass in a bunch of states. Since it isn't renewable, it can't get a long-term contract. So that was, sorry, Ellen, I threw you, that was a red herring. That was an aspirational.
No, I think it's something that, it should be on the horizon. If we're going to be spending all this money retrofitting, fossil projects that continue to have, long operating lives and maybe, can be retrofitted and operate going forward, either low emissions or in some cases no emissions, but, there needs to be a market for that power. And to the extent there's costs incurred, that power should be priced a little bit more than it would otherwise.
Well, there's a study done in California, the conclusion was something of the ilk of gas with carbon capture is indispensable, and without it, you can't hit their targets for carbon reduction cost effectively. But right now, you couldn't get a contract in California, for fixed price for plants.
Well, so this is a slide here that sets forth the code for CLE credit, and I'll just read it twice. NPCLE 091720. Again, NPCLE 091720. Okay, so just very quickly, we're running out of time here, but the focus, I think that's going to be the primary issue is what's been teed up by Jeff, and and sort of the requirements of Chris and Khalid, which is probably not unlike any other project finance lender. Show me the money. Where is the consistent cash revenue stream that I can lend against? And the challenge here is to find that in what could be a negative cash flow environment. And we've identified a couple of potential revenue sources listed out for each of these particular entities in the structure. And one is the carbon disposal price. There might be a carbon price paid by the sequestering company for either the benefit of the carbon or the benefit of a pass-through 45Q credit. There might be some credits out there in the marketplace in certain states that exist, in California in particular. There might be some voluntary carbon credit regimes that might generate value for either the project company or third parties that might be interested in purchasing it and being able to claim achievement of certain standards of green. Possibly in the future there might be a carbon benefit through a federal regime. And then, if there's a commercial use, you might be able to get paid for products such as concrete or other products that have commercial value that where the carbon is used. On the sponsor side, let's say the tax equity investor is going to be making various payments over the life of the deal, both upfront and over on a mandatory non-contingent basis up to 50% of their expected investment. And then, as mentioned earlier, there's a 50% pay-go, which which is a payment that's going to be made over time as at the end of a year, once the particular year's credits have been tallied up, and that would be a non-committed, it would be contingent. And so those are the possible streams that I'm aware of. There might be others in different circumstances. And the real challenge is, how do we marry that with, the demands of commercial lenders? So, back to Jeff's kind of hinting at, the need for potential clarification by the IRS and subsequent regulations for clarity on the ability to do these projects, notwithstanding the fact that they might be cash negative and not run afoul of the economic substance rules, in order to completely provide the comfort levels that are needed for the tax equity investors and others to go forward with these deals. And there's probably a lot of other things on the list in terms of clarifications, which we'll talk about. Okay, so this is a structure that I'm not sure everybody has actually seen. It has been done in deals for renewable energy projects. And there's a lot on this slide, and I will be sure that everybody on this call gets the slides here. But in a nutshell, it's looking to effectively back leverage the tax equities contributions through what is a tax sharing agreement with its parent company. So as and when tax savings in this case would be achieved through the generation of 45Q credits by a tax equity borrower here that's in the consolidated group with this tax equity parent, or depreciation benefits, all based on its investment in this CCS project, which is on the bottom. The tax equity parent would be required to pay an amount into the tax equity borrower, and that money pursuant to that tax sharing payment is assigned to the what I've called the TSP lender here, and the TSP lender will lend against that cash flow. It might not be 100%, and the cash flow under the tax sharing agreement itself might not be 100%. It might be some percentage of the tax credits or the tax savings that achieved. But at the end of the day, this is a way for the tax equity borrower to leverage its investment. So it will be making a cash investment that's not leveraged, but together with the leverage part. And this TSP lender is going to have to do the same diligence and whatnot as a lender that would be lending directly to the project company, because it's going to want to know that it stands alone. It has all good counterparties and all of the issues that a project level lender would be concerned about. It also is going to through this mechanism basically enjoy the benefits of the indirectly the 45Q credit, and will have a security package that is consisting of the equity interest in this borrower and an assignment of these cash flows. It is not exactly what I think Khalid and Chris were referring to, but it is a structure, and we are going to talk about it with whoever would like to talk about it and see if it might be something that can be implemented. At the end of the day, this doesn't actually support the 50% pay-go. And I'm just going to flip to the next slide. This is sort of incremental financing that we see available, again, sort of on the back of the tax credit. And this would be either a loan that is made by what I'm going to call a PAYGO lender into the CCS project company, or into the B member, which is the sponsor side of the tax partnership. And in renewable deals, you often see back leverage through the B member, and that solves some of the issues in terms of foreclosure that a tax equity investor might be concerned about. But in theory, this could be at either level, and it's lending against either all or a portion of what's available there through the 50% PAYGO, and basically funding that up front and allowing that to be used to pay off construction related expenses at COD. There's in the guidance that came out around February or March, Revenue Procedure 20-12, it does contemplate that tax investors can make, in addition to these 50% contingent PAYGO payments, they could pay operating expenses into the CCUS project, and they do that to keep the project afloat so that it could continue to generate the tax credits. Again, this is all based on hopefully an understanding or articulation by the IRS that a negative cash flow situation down here isn't going to make this not stand for not satisfy the economic substance rules. So the 50%, the operating expenses would be addressed presumably through that a commitment by the Class A member, and what sort of net of all of that would be distributed either to the Class B member or available to satisfy debt service at the project level. The forbearance discussions could be kind of complicated here, and I've tried to put some thoughts down, but I'm just going to try to keep going since we have 15 minutes. Okay, finally, the final slide here is what Jeff was referring to, where there would be sort of two projects under this partnership, and we could see other structures. I just try to do this in a way that presented the possibility that the Class A member is a part owner of the emitter. It could be that it's part owner of the sequestering company, or it could be that the Class B member itself just owns the emitter or the sequestering company. And in any of those instances, it could generate additional cash flow to support a loan facility at the Class B member level, and that would be combined with whatever the 50% PAYGO structure might benefit.
Hey, Ellen?
Yeah.
Can I throw in, if you just go back to that slide, for people who aren't as familiar, look, there's a general principle with the IRS that you can't buy tax credits from people every year. To say, hi, I'll buy your tax credit if I can use it. But the two big exceptions here, one is the box that they will let you put your money in to an extent over time in one of these partnerships. They said, well, you can kind of halfway buy tax credits over time as long as you initially put up a whole bunch of money. But the other one is that your tax sharing agreement says that rule doesn't apply when you have two people in the same tax group. So you can have one company inside a big company and it can't use the tax credits. Well, it can cut a deal with its parent, its 100% owned parent, because they're all inside the same tax group. So that's kind of, if you think about it, the real problem is you can't just sell tax credits out at the street corner, and you're trying to figure out ways to get around that
Yeah.
because you need to turn them into cash.
I'm gonna let Sharif pop in here. So Sharif and I have been providing comments to some of the IRS regulations, proposed regulations, and one of the issues is what you just touched on, Jeff.
Yeah, I mean, I think what we find with these projects is that they look more, they just look more like sales of tax credits, especially in the ones without revenue streams, the non-EOR type projects. And so unlike wind and solar, where you kind of have underlying businesses, we along with others in the industry have been asking Treasury to kind of more explicitly bless non-cash structures, where the investor really only is taking credits out of it. I don't know, Ellen, if there's more you wanted me to touch on with that.
No, that's fine. Thank you. So I really think we probably need another hour to go through these slides. I apologize. I was going to maybe have Khalid and Chris take a moment and just maybe to highlight some of the key issues that they would be, focused on, when presented with the CCUS project.
Sure, I'll take a stab at that very quickly. And I'm really glad we had the discussion about power purchase agreements, because that is the core of our ability to finance generation and has been for many decades. So we would be looking for a very bankable power purchase agreement. And if the project depended upon the sale of carbon, we would probably look for a bankable carbon purchase agreement. And so I think that was a very helpful piece of discussion, particularly that's how the whole rural utilities G&T and distribution cooperative relationship works, and that's what makes those big projects financeable in rural areas. So we would be looking to replicate the PPAs. So if a state prohibits it, that would be an issue.
Khalid, anything to add there?
Similarly, I think I'm going to rely on what Chris said as well as what Jeff said. I think the doable project would be, with a product which would be the power or other petrochemical. If there is any other product in addition to CO2 revenue, whether if it is an EOR, then you get a revenue, but if it is a geological sequestration, other than the tax credit, there is no other revenue coming in. So that would be an ideal project. Now, obviously, we know that there is not a whole lot of project exist, where you can have an additional product revenue coming into the to the project. So in that case, it's going to be challenging. We have to rely on how we can structure in a way that the cash flow coming to the waterfall, is sufficient to cover O&M and debt service. That is a challenging part. Just to comment on one thing that we would have to, by regulations, we can lever up to 80% into a project LPO. That is the maximum we can go. The remaining, has to come as an equity, before the construction starts. But then the question is that if you're trying to bring a tax equity, but they don't come until the COD, so there is a gap there. Maybe a construction equity, provider could come in and partner and fill that gap during the construction time and can take the construction risk. And then, at COD, maybe the tax equity could come in, and pay out the construction equity provider.
Right. Well, I think my focus on these slides had been more on the term period, and assuming that there's a solid takeout, the construction lender would get comfortable. Maybe this is this was a question that I was thinking about as Chris was talking about his timeline, and I expect that the DOE has a timeline as well. These are projects that take a very long time to develop, permit, construct, and then finally get to operation. And there's risks along the way, and you want to know that you have the financing in place, and ideally at a price point that you're comfortable with, at least that you know about, and because you're building your capital stack and you're creating your financial model, and you need to know where everything fits. With some of these government programs, there's an availability issue. There's different administrations, perhaps. I mean, how does a particular borrower sort of firm up an undertaking, or a commitment from you, given that they might not be actually using the funds for several years forward?
We get into initial consultation, to understand, the purpose of the fund, and then when the construction would start. So we go into the consultations, but mostly it has to be transparent, and again, we can have a credit facility. In other words, the disbursement of fund, and it can take in a different stage. It doesn't have to be upfront. So that's where our flexibility comes in. We can be flexible in terms of the disbursement of fund at different times.
Okay.
Yeah. So for RUS, where we don't, we don't take the construction risk, we will have the obligation lined up, but the borrower is at risk during, or the developer would be at risk during construction. So, but we've been able to develop some pretty significant assets over the year. We've got a very large portfolio. It is tricky because you've got kind of two sides of risk. You get the risk of the generation as well as the risk of the utilization of the carbon. And again, this presentation showed the challenges of the economics. So my ears were perking up on your suggestion that there could be extra sources of revenue, whether it be state incentives for carbon, or even private sector entities willing to lock into let's say a power purchase agreement with a large Fortune 500 company that wants to be able to be carbon neutral. Well, maybe that would be a bankable way to do that. But yeah, there's the more innovative we get, the more difficult, the more tricky it gets to do the financing.
Right. So,
but it's easier to do. It's easier to do a complicated project with low interest rates than high interest rates.
Absolutely. So I've skipped over a couple of slides, and again, I'll distribute everything to everybody here. But one of the things that given that we have folks here that have relationships with existing tax-exempt entities, and I think Jeff has been focused on this a lot from his experience with the University of Wyoming. There are a lot of these existing emitters out there that would like to find a way to advance a CCUS project and decarbonize their existing projects. And because it's a tax credit that only really benefits taxable entities, how do they do that? And we've come up with some ideas, and I think that in general, the first point here, which I kept double checking and triple checking within my firm last night, the ability of a tax exempt to actually own or partially own the CCUS project doesn't make it ineligible to receive the 45Q tax credits. That would not be the case in terms of other types of investments that might benefit from other tax credits in other parts of the code. So in theory, they could partner with a tax investor and move forward. And the only thing is that the depreciation would not be accelerated as it might be with private investors. And the other structure that we are continuing to think about, and there's a lot in the tax code, and I think we're still trying to make sure that we haven't missed something, but long-term leasing and a tolling agreement where a CCUS project might be constructed by owned by a taxpayer and a sponsor, or just by a taxpayer, and then the use of that project is providing for long-term benefits through a lease or a toll to a muni or a co-op. Again, we want to make sure that there are no other sections within the tax provisions that might trip us up here. But from our perspective, this would certainly provide a steady stream of payments that could be backstopped, with debt, and it could provide a way for a co-op or a muni to benefit from, indirectly from the 45Q benefits, tax credits.
Another thing to think about, we do have authority to relend. In other words, to make a loan to a utility, and the utility can relend, but it is for the purpose of energy efficiency. So if a project could fit into that category, we might be able to make a loan to the nonprofit electric utility. The nonprofit electric utility can relend to the carbon capture for-profit entity and pass the savings along to the for-profit entity. And then we would get our security from the nonprofit utility. But there we would have to be able to make the case that that's an energy efficiency move. I suppose if Congress would to say energy efficiency or carbon efficiency, well, then that would be even easier to do. But I think that's another structure to think about. I haven't seen it step forward as a reality, but we have talked about it and have looked at that as an option.
Okay. I'm gonna just let's see. Yeah, that's a couple of other considerations here. I'll just keep that on. I think what we should do now is go to the Q&A, since we were supposed to end at 2:15, but I think we'll just keep going until 2:30 and try to cover the questions that have come in. Sharif, if you want to do the honors.
Yeah, so I've compiled a good number of questions here for us, and what I'm going to try and do is take them a little bit out of order and hit on some of the ones that I think are more mechanical, relating to some of the programs that were discussed, teasing out some of the contours of those, and then there are a few really good kind of discussion primer questions here as well. I think the first one we have here was from, or that I want to bring up here, is from Manish. Sorry if I said that wrong. But the question was for Chris with the RUS. Do your engineers make the decision on technology if it is proven or early proven? And Manish, follow up in the chat box there if I missed it, but I think you're kind of getting at the technology risk appetite of RUS.
Sure. Again, our standard is proven technology, and a technology that is suitable for rural purposes, right? So we would probably have many consultations with our friends across the street in Washington, D.C. at the Department of Energy. Again, our engineers are really top-notch. They are capable of making that decision. And the technology we're talking about, carbon capture, sequestration, may be assembled in unique ways, but there are projects that are operational. So I think we can look, to projects here, the couple that are here in the United States, as well as some in Europe, and we can kind of look at the fundamental principles. But you don't come to RUS to do a demonstration project or a technology experiment. We want to be able to know that it is a proven, useful, and again, appropriate for rural service.
Yeah, and another real specific question here for you, Chris. Do you need to have the environmental review completed before RUS is willing to consider the application, or can you issue a conditional loan commitment effectively based on the NEPA coming in later?
Okay, so that's a very tricky question. Probably the safest answer is to say, yeah, we have to get through the environmental review before we can seriously do the underwriting. It's not impossible for us to double track or triple track a project. We have triple tracked a project where we did underwriting, documentation, and environmental all at the same time, but it was a very simple, straightforward one that we didn't have any really major concerns about. What you don't want to have to do is expend resources on a project that never passes out of the environmental stage. So that's the problem. Or you don't want to be able to make economic, underwriting decisions or financial decisions, and then have the whole model change because of mitigation strategies that you're required to accept at the end of the process. I do have in our environmental regulations, we do have some ability to obligate subject to completion of NEPA. It was very, very limited. And it's really to be used for like, well, maybe I'm missing one letter from the Fish and Wildlife Service before I could close this account out. And so I'll go ahead and obligate, and then I'll quickly in the next fiscal year be able to get that documentation, and then we'll be done. And then I would say that our council is very cautious about using that authority in controversial cases. So yes, you need to get through the environmental process first before you can seriously get considered, and that's when we'll really start working on the application. But you have to have a fully developed application to start the environmental process.
Great, thanks. And I think the next one I'll go with you as well, but I think it's applicable. I'd like to hear from Khalid as well. I think for both of your presentations, there was a lot of focus on power generation and the need to be connected with energy, given your authorities and mandates. One of the questions we have here is, could you finance a storage project or a pipeline connecting the sources and the storage facility that might take industrial CO2 as well as power plant CO2? Or, does it need to be more exclusive than that?
Let me go first on that one. Yes, we can finance a pipeline, which is transport the CO2, which can go to a storage, or the source could be a power plant or a petrochemical facility. That transport is critical, to move those CO2 as a commodity into its destinations. So without the pipeline, you cannot move those CO2. So in that case, we would be able to look into that type of project. The challenge is going to be the tariff. What would be the tariff rate here to transport? So that would be the challenging part, so that the pipeline can be bankable. So it requires a further due diligence and discussion.
Yeah, and for RUS, the key is who owns the pipeline, who owns the asset. I mean, is it part A standalone pipeline, probably not within my authority. We do have sister agencies, the Rural Business and Cooperative Service, as well as the Rural Housing Service with a program called Community Facilities that potentially could finance those assets, but they don't have a lending level that is as high as mine. So it's not like Department of Agriculture can't do it, but RUS probably couldn't do just the pipeline. But if the pipeline were owned by the electric utility and an essential part of the electric utility's generation, we could do that. And the parallel is we have financed a railroad spur owned by the power plant in order to get access to cheaper coal. So, you know, that's comparable to the pipeline, but there it was just a spur, and it was, you know, the pipeline would have had to be owned by the borrower, which would be our electric utility.
Okay. I think a bit of a mechanical question here. We'll see. With both of your authorities, are you, one of the questions we got here, you know, do you see investors willing to invest in sequestration non-EOR projects without a separate store co? Is that feasible given the long-term sequestration liabilities? And I think just to kind of broaden the question of how you guys kind of went to this question based on what you just said, Chris, about who owns it. You know, how are you thinking about the ownership there? Would you be able to, if it's owned, let's say, by the right type of entity, but it's in its own standalone entity, it's just the storage unit, and let's say you have the kind of the bankable contracts on both sides that you need. Is that something you're interested in, can do, or do you have a preference for a different type of ownership and kind of structure?
Yeah. So the fundamental question for us is, under our statute, can I finance just a storage facility? And I think that's probably an unlikely. Maybe not impossible, but it's probably unlikely. If the storage facility were owned by the electric utility and it was part of the electric utility's pollution reduction, you know, again, it was necessary to be able to generate electricity that you could sell given EPA rules or whatever, then it probably could be financeable if it were owned by the electric utility. But yet, what you raised about long-term liability is something that does worry about, and we would probably want to look at some risk mitigation on that too.
We'll get to risk mitigation. That's actually going to be the next question I get to. Talking about insurance was another question we had. But Khalid, was there any point you wanted to add there on kind of the ownership structure that you guys have a preference or kind of statutory constraint with?
No, we do not have any preference. I think the challenging part is going to be, well, this is going to be a geological sequestration. I think that's what I'm guessing, because most of the EOR is done by large oil companies. So in this case, it would be basically a geological sequestration. You will be exposed to the Class 6 permit, and then all rules and regulations and the liabilities and decommissioning, all those comes along with that. So that is the challenging part, you know, but we do not have any restrictions, you know, in terms of providing fund for a specific to CO2 geological sequestration. We don't have any restrictions on that.
And let's transition here then to that risk mitigation that was just touched on. And I want to make sure, Jeff, that you get an opportunity here during Q&A. Why don't we start with you? The question we have is, you know, one of the IRS guidance that just came out, the revenue procedure says that the taxpayer can obtain third-party recapture insurance to protect against recapture. So we know that insurance products are going to be allowed, thought about. We at Nixon hosted a webinar recently, a few weeks ago, a month ago or so, about insurance specifically. But how do you envision the use of recapture insurance and maybe other risk mitigation measures for these projects?
Well, quickly, and I can't remember, are they still on the 5-year recapture period, or have they changed it?
Yes. Rolling kind of 5. Yeah.
Right. So just for people who haven't followed it, the issue is if you put in 10 million tons underground this year, and then 5 years later, 10 million tons leaks out, and maybe it's right at the end of the project, what happens to you? And so, right now there is a 5-year recapture period where some or part of what leaks will create an obligation to pay back to the IRS the tax credit you already earned. So I think, Sharif, they say you can have insurance. It's almost like with this fairly long, I would call onerous capture period, it's theoretical recapture. Probably equity is going to want to go out and get that insurance, or else it will use the recapture as an excuse to have quite a high discount rate on the benefits, right? In other words, you have a wind farm, you earn a PTC, the power goes on the grid, somebody uses it to run the toaster, done, over, no recapture. So here you have a nice tax credit, but it could be grabbed back from you 5 years later. That's very unattractive. So yeah, if you can't get insurance, you're going to self-insure by effectively not paying very much for the credits. It's an issue. And I don't know how, I don't know if anybody on the phone has seen actual real major insurance companies who are willing to write these policies and, have gone through the process. I haven't.
All right, yeah, I think hitting that, you hit a nail on the head. That's what came out of our last session is these insurance policies are going to be unique. Investors are going to want them, but how they kind of fit together with what people traditionally think of as policies, recapture is a unique, it's new.
We recorded that session in case anybody wants to have a link to it. Just give us an email, send us an email.
Well, we got a few minutes left here, so let's go back to Khalid and ask, on risk mitigation, what are you thinking of, and what kind of role do you see insurance playing in your own underwriting requirements or process?
Let me go first. In terms of risk mitigation perspective, I'm agreeing with Jeff on that front that it is a challenge in terms of recapture risk. We don't know yet exactly how it's going to pan out. But the other component of the risk, let's say that if you're considering a pay-go process, whereas the money from the tax equity is coming to the waterfall as a source of fund, then there is simultaneously we have to also look into the production of CO2. That's also how viable that is. Is there any kind of technological challenges there that if for some reason, if it is a power plant or chemical plant, if there is a hiccup or they get shut down, then there won't be no revenue coming in from the tax equity because there's no carbon being captured. So the question is that can we solve the problem on the technology side that for whatever the reason, if the project does not produce CO2, can you keep that revenue as whole, or if there any kind of mitigations risk, to capture that revenue? So that's kind of like something to think about, that some insurance company may feel comfortable, to provide that type of risk mitigations. I'm going to pause there. Thank you.
Hey, Clay, can I follow up, which is just to make it simple, right? You paid up front for half, and you're going to pay over time for half. So the question is, if all of a sudden you lose a quarter of your tax revenues, right? Those go away. Which piece gets hit? Is it the piece that you were paying for every year, right? Are you saying I already paid for my first half, and then anything above that first half, I will pay in cash? Or do you flip it around and say every year, if up to half of the expected amount was captured, I'll pay cash, and if there's a shortfall, that hits my original investment? It's kind of first in, first out, last in, first out. You can run it either way, honestly, but clearly the tax partner would rather have it the way that if there's a shortfall, I reduce my annual cash payment. the pay-go piece gets hit first when there's a shortfall. That's what he would like.
Yeah, that's right. You know, so if you are counting that cash on your waterfall to cover some of the O&M and debt service, so that there is no shortfall there, then you know how do you mitigate that risk? That's what I was referring to.
Right. You could mitigate it contractually. Say, you know, first loss goes to the original amount I put in, rather than first loss goes against the annual payment amount.
I'm not so sure the investor would agree to that, but
Oh, no, we wouldn't need to hate
exactly.
it. You know, it's worth a try.
They have a lot of leverage.
That was the second point on the 50% pay-go risk, if that's the first loss position or not.
Let's give Chris the last word here. Just a few thoughts on your thinking on risk mitigation, insurance, other techniques. What do you envision coming together here?
Yeah, so I if insurance is available, that might be worthy of looking at, but it will certainly come at a price, which then will affect your overall financial feasibility. And we would look to maybe guarantees from other parties, or if there's a parent-subsidiary relationship, a parent guarantee, and we would, you know, could look at the value of the collateral. I mean, that's frankly where we get most of our risk mitigation is having a strong collateral.
I know we've talked about this kind of in some of our pre-calls. Khalid's mentioned, you know, well, how valuable is the collateral? It depends on kind of what goes wrong, right? If your emitter goes wrong, well, your carbon capture equipment may not be worth anything. So I think those collateral packages are really important. But with that, I know we're kind of at the bottom of the hour here, a few minutes past. I'll turn it back to you, Ellen, to wrap us up here.
Okay, great. You know, I think we could probably continue talking for quite a while. These are really difficult and interesting projects, and I think there's a lot of opportunity for creative thinking. And it sounds like our contacts here at DOE and RUS are up for you know, considering well thought out propositions and ideas. So I encourage you to reach out to them, as well as Jeff and Nixon Peabody if you have any specific questions or need help structuring these deals. And with that, thank you very much for your time, and stay healthy, and you know, look for additional webinars that we'll be hosting in the future on this subject. Thank you.
Thank you very much.
Thanks, everyone.
Thanks, Ellen.
Thank you.